So this is chapter 25, part 1, lecture video. And chapter 25 goes together with chapter 26. And both of those chapters are about decision making and using incremental analysis to help us make decisions. Chapter 25 is differential analysis, which is more decision making based on income, the effect on income. And chapter 26 is going to be decision making, which would be looking at the effects on making capital investments. So investments in factories and buildings and equipment and so forth. But both chapters I think are important, especially the next chapter, because that is the way that that analysis is done in just about every organization you would ever be part of. This chapter, on the other hand, I think provides some important concepts of finance. And it's also, I think you can see in practice how this works. And it also is really a pretty simple way to make decisions between two alternatives, and something that you could use in your everyday life when you think about deciding to do one alternative or another. For instance, this type of analysis would be helpful in terms of thinking about leasing or buying a car, maybe refinancing or not refinancing your mortgage. So things like that, where there's two alternatives. It can only be used for two alternatives, but you can look at the differential effect on income or on your costs of doing so. So that's what differential analysis is. It's really what's called the differential or incremental effect on income, okay, or costs of choosing between two alternatives, okay? And so this method only works between two alternatives. It's not robust enough to really use between a number of alternatives. And that's where we would use the next chapter to help us when we are looking at maybe 6 or 7 or 20 projects for that matter. This is simply between doing something or not doing something, or between two courses of action, but only two scenarios. So let's take a look at how this might be used in practice. So this would be an example. Say, for instance, let's say you work for a hotel chain, and somebody like Hotels.com pays you a visit and says, hey, we noticed that your normal room rate is $179 a night, and we'd be interested in advertising a certain number of your rooms at a special rate of $80 per night. So basically what they're telling you is that what they would be willing to do is to offer up your hotel rooms on their website. It gets a lot of obviously visibility. The problem, however, is that you're not going to be able to charge $179 a night. You're going to only charge $80 a night. And the question is up to you to determine whether that makes sense or not for your company. Okay, so the first thing you would do is you're going to maybe take a look at, what is my fully allocated cost per room? So I have an understanding of what are my costs per room. And then if I compare that to my $80, am I going to make any money? So this would be taking all of the costs for the entire hotel, maybe dividing it by the number of rooms, or determining how much time it takes, maybe on an activity based cost method per room, given the size, etc. And what you end up with is the following. So it's determined that the housekeeping labor to clean the room is $36 every time the room is rented. You bring in housekeeping labor, and it costs $36 to do that. Now, the good news is that the housekeeping labor is part-time. labor, it's flexible, so you only need the housekeeping labor. You only have to pay for it when you need it. So if you're not going to rent the room, then you would not employ the housekeeping services. You would not have to pay that labor cost. So it's either there when you need it, but you don't have to pay for it if it's not there. So that's $36. The hotel insurance and property taxes that we're paying on the building and the operations is $40. And again, this is just for example purposes. Obviously, these are not all of the costs of the hotel, but we're just going to keep it simple, okay? So we can kind of understand how this works. Room supplies, so these would be, the little chocolates, mints, soaps, shampoos, things like that are supplied each time the room is rented. That's $7. Laundry supplies, every time the room is rented. Of course, the linens are done, the towels are washed. This would be all the supplies to wash the towels and sheets and things like that. That's $10. The front desk staff, the concierge, the other people that are there at the front desk assisting customers is $6. And the cost of cooling the entire building, we're going to assume that the entire building is cooled through one central location. This does not include the cost if somebody wants their specific room at a lower temperature. This is cooling the entire hotel, the lobby, the convention center rooms, and so forth. That's $4. So if we add all that up, we end up at $103 per night, per room. Now, at first glance, you would ask yourself, my costs are $103, and they're asking me to basically rent this room for $80. On the face of it, that would look like, on a fully allocated basis, I'm going to lose $23 by doing this. Okay, so that would be just at first glance. Now, the question is really, is that really the incremental effect on income? Okay, so what we're going to do is we're going to set up a table to analyze the differential effect on income, the differential effect of choosing one alternative versus the other, and we're going to determine whether or not it makes sense. And it may be a slightly different analysis when we're done. And it may not be simply that, no, we should not do it, and we're going to lose $23 by doing this. So let me go ahead and set up, so that is the question. Do we want to rent the room at the special rate of $80? And right now, it looks like, wait a minute, that's going to produce a loss of 23. So I'm just going to move this up a little bit. So what we're going to do is we're going to set up a differential analysis. First of all, we're going to set up 3 columns. Alternative 1 would be to don't rent the room. Alternative 2 is to go ahead and rent the room. And alternative 3 is the differential effect of choosing alternative 2. Okay, so it's very important. This is always going to measure the effect of choosing alternative 2. And what we're going to do is we're always going to take column 2 and subtract column 1. So 2 minus 1. And what we're going to do is we're going to have, over here, we're going to have revenue. And we're going to have cost. And that's how we're going to set up our differential table, differential analysis table. And what we're always going to do is we're basically going to measure the differential effect of revenue, differential effect of costs, and then in the end, that should give us a differential effect on income. Again, of picking alternative 2. All right? So let's start with if we don't rent. If we don't rent, the revenues would be, of course, zero. We would not have any revenue from the rental of that room. If we do rent, we would have the $80. So again, the differential effect here would be column 2 minus column 1. So 80 minus 0 would be $80. That would be the differential effect. So we're going to go ahead and continue to do that with all of our costs. So housekeeping, and I'm just going to abbreviate to make things go quicker. So housekeeping, if we don't rent the room, because this labor is part-time and we only would contract that if we need it, we would not have any incremental cost. If the room was empty, we wouldn't need the housekeeping. If we did rent the room, we would need the housekeeping. We would incur $36 of cost. Costs, by the way, are always going to be negative numbers. Okay, so revenues are positive, costs are negative. We're going to differential effect here. So 2 minus 1, a negative 36 minus 0 is a negative 36. That's the differential effect on income. The second one would be the insurance and the property tax. Here, if we don't rent, we would still have that cost. We would still have the property taxes and insurance on the hotel. That's going to continue regardless of whether we rent the room or not. And if we rent the room, of course, it would still be there as well. So the differential effect here is minus 40 minus a minus 40, or minus 40 plus 40, and that's 0. So no differential effect in this particular item, because that's going to be there regardless of whether we rent the room or not rent the room. The room supplies and the laundry supplies. If we don't rent, we're not going to need those room supplies. So that's going to be a 0. If we do rent, we are going to require those, and that's a negative 7. So differential effect, negative 7. Same thing with the laundry. Soap and everything else. If we don't rent the room, we're not going to need that. If we do, we are going to require that. That's a negative 10. Okay, the front desk staff. Front desk staff, whether we rent the room or not, we are going to have the front desk staff there. They have to be there for everybody. And whether we rent the room or not, they are going to be there. So, again, 0 effect. I'm just going to move this up a little bit. And finally, the central air. Whether we rent the room or not, we're still going to incur central air conditioning costs. We're still going to be cooling the entire hotel, whether we rent the room or not. So that's going to be a cost regardless of whether we rent the room. So there again, 0 costs. So now we're going to look at the differential effect. So if we don't rent the room, we're going to end up with total costs of $50. If we do rent the room, we're going to end up with a total loss of $23. And if we add up the differential effect, we see that that's $27. Whenever this number is positive, we accept alternative 2. So in this case, we would rent the room. There's a differential effect of 27. So we're better off by renting the room by $27. And that makes sense, because if we don't rent it, we're going to incur a loss of $50 because those costs are going to be there. If we do rent it, we're only going to incur a loss of 23. We're 27 better off by doing so. So that says we should rent the room.